Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we talk to someone interesting about something interesting. Tony Alexander, the BNZ Chief Economist, is here releasing the results of the monthly survey BNZ does with the Real Estate Institute, where it asks real estate agents how they are seeing the market, what activity they're seeing. Tony, what was the broad outline of the response for this month's survey in terms of how interested people are buying, selling, activity, that sort of thing?
Yep. Main responses to come through would be that we are still seeing very strongly growing interest from first home buyers in the housing market. The investors are pretty much sitting on their hands and really don't want to do much at the moment. The vendors are placing a lot of pressure, it seems, on agents to get the houses sold. So you'd still say technically it is a buyer's market for sure, but the vendors don't want to cut their prices.
What's that about? Because in other countries we've seen some of those price cuts happen.
Yeah, definitely. And I think what we're seeing overseas is their unemployment rates are much higher. You know, you're 8.6 in the United States or 15 in Ireland, etc. And also strong awareness in those countries of a massive oversupply of property. So a very strong feeling by people that I'd better sell this thing as quickly as I can because, man, it's going to be worth even less in a few months' time. Not so in New Zealand. I think there's increasing awareness that the construction has been very weak, near a 4-decade low recently. The unemployment rate much lower at 6.6%. The debt servicing costs have fallen away quite a bit also. If you go back to 2008, interest payments versus income were about 14%. Now we're around about the long-term number of 9%. So the pressure simply isn't there on vendors to sell quickly, get on with life.
One thing that came out is that some people are looking to trade down. What were you seeing there?
Yeah, we're seeing an increasing number of agents saying that when I ask them why are buyers looking to buy, and more are saying, well, people are looking to buy because they want trading down house. They want either something smaller, cost less, lesser suburb, etc. And thankfully, we get the same result when we ask agents about why are people looking to sell, and there's an increasing proportion to sell because they want to trade down, as it were. So, yeah.
Could they be deleveraging in a way?
I think some people are still deleveraging on an individual basis. In aggregate for the New Zealand household sector, you can see it in the debt to income ratio definitely coming down about 155% to maybe 144, but debt levels in New Zealand are still rising by about 1% over the past year. In the States, they've fallen almost 9% in the past 4 years. So deleveraging means a slightly different thing in New Zealand.
What is the survey showing about the regional differences?
For the regions, the main thing would be that Auckland sticks out as being the strongest part of the market, with certainly the first home buyers active, the investors more active there than in most other parts of the country, and the price pressure upward comes through more strongly than in most other parts. Christchurch sticks out as having, you'd almost have to say, definitely no interest from investors down there, which I find a bit surprising given the talk of rental property shortages down there and very good rental tenants coming through as, you know, people with their home are looking for somewhere to rent for a while. That one may change. Wellington's interesting in that you have very much a buyer's market, a net 50% of agents reporting there that the sellers are far more motivated than the buyers, and yet the prices are still strongly perceived as rising there. Dunedin is looking relatively strong as well on pretty much all the indicators, and for all the regions we look at, every single one of them is saying there are more and more first home buyers about, except Queenstown, Central Lakes district, where there's been a bit of a pulling back and some of the first home buyers seem to have disappeared there.
The Economist magazine came out a couple of weeks ago with a survey showing it said that New Zealand's house prices were up to 25% overvalued. What do you think that means?
Yeah, I mean, they're probably quite right in terms of using those house valuation measures, so no quibble in terms of the numbers they've produced there. The issue, though, is when we see a number like that, we're invited to form an implication that this means house prices will fall 25%, and I don't think that's going to be the case at all. If our house prices were going to significantly adjust downward, it would have already happened with the global financial crisis and our own recession. As I've said in the context of exchange rates for 2 decades now, if a thing is viewed as overvalued 10%, it was first of all overvalued 5% and didn't go down. It might be overvalued 10% because it's on its way to being overvalued 60%. So valuation measures give you practically no predictive power. They really don't tell you where things are going to go. And when I look at New Zealand house prices, I see still extremely weak construction. And when the construction gets humming next year, the builders won't be there. They'll be in Australia. They won't have done apprenticeships. They'll have retired, etc. So, I don't see the house prices correcting. I think they creep up.
Now, looking at the interest rate outlook, tomorrow we have the Reserve Bank making its announcement in the December monetary policy statement. Yesterday we had Australia cut its interest rate. What's your view on interest rates in New Zealand for the next 6 to 12 months or so?
Yeah, I think the best assumption there would be that they will remain static. Our cash rate sits at 2.5%, whereas in Australia, even with 2 lots of 0.25% cuts now, they still sit with 4.25%. So ours are already offering more insulation value to our economy, as it were. But I expect very strongly the Reserve Bank of New Zealand, like the RBA, will note these severe negative risks from what's happening in Europe. The fact that simply nobody knows exactly what's going to happen across there, where the Bank of England governor is talking about a systemic risk to the banking sector. This is fairly strong stuff, and I think for the Reserve Bank of Australia, they've taken a wee bit of insurance against a negative flow through, and also and especially strongly on the basis of the weakness creeping into China at the moment. Slower growth in exports, slower growth in retail spending, and also the manufacturing sector looking like it's shrinking. These things will flow back a bit to New Zealand as well. Why won't the Reserve Bank cut tomorrow? Number one, our commodity prices are holding up fairly strongly, and the Kiwi dollar on an average basis has decreased quite a bit over the past couple of months, and I don't think they will feel the need at this stage. But if Europe were to fall over, they'll cut, no hesitancy.
What does that mean then for fixed versus floating?
The fixed interest rates, certainly for the 2-year, maybe out towards 3-year, are pretty attractive by historical standards in New Zealand. I don't believe we, in the short term, will be seeing the fixed interest rate shoot up. So if you're planning to fix, I don't think there's necessarily any hurry at the moment. When I look out there at the economy here, and when I look out overseas, I analyse our recent retail spending numbers, it says to me the risk is our monetary policy doesn't change for quite some time. It says to me I'd probably be quite happy sitting floating practically through to early 2013, quite possibly.
Tony Alexander, the Chief Economist for the BNZ there, with the monthly survey of agents with the Real Estate Institute. I'm Bernard Hickey for interest.co.nz.